Hello and welcome to the SC Launch and Learn with Peter Barton and Ryan Loveless with the accounting firm of Elliott Davis. Today we are talking about exit and succession planning. Before we begin, I'd like to go over two housekeeping items. First of all, if all the attendees can hear me, can you please raise your hand in the webinar controls? Sheldon, Steve, welcome. Thank you. Thank you. Y'all can go ahead and lower your hands now if you can hear me. Great. Thank you so much. Secondly, on the format of today's webinar, we will be keeping the audio muted for all participants. So if you have questions, please feel free to type them into the webinar controls at any time. And then about 20 minutes in or halfway in, we're going to open up the Q&A, and I will read the questions out loud, and our guests will answer the questions. So again, I'd like to welcome you all here. We've got more attendees filing in as we speak. I just want to say congratulations to you all for understanding the importance of exit and succession planning when working through your business plan. This is a really important topic. So I just want to introduce our speakers. Ryan and Peter are both directors with the accounting firm of Elliott Davis, which has offices in Greenville, Columbia, and Charleston, as well as other metro areas around the Southeast. They're both accountants that provide early stage companies with financial leadership to support and grow initiatives. And you know what? I'll let y'all read their bios on their website, but in general, if anybody has ever told you as a small business or an early startup that you need a part-time or fractional CFO, these are the people that they're talking about. So they will, soup to nuts, they'll be able to help you work with your practice, work with your business, and any price that fits your budget. So I just want to extend a welcome to Peter and Ryan. Thank you so much for joining us. My name is Julia Linton, and I serve as the operations manager for SC Launch. Again, welcome to Peter and Ryan. And now I'd like to hand the mic over to you guys and tell me a little bit more about the importance of planning for this exit and in a company's life. So the mic is yours. Thank you for joining us.
Great. Thank you so much for that warm welcome, Julia, and it's a pleasure to be here with everybody today. Encourage you to use the chat box and look forward to fielding your questions when they come up later in the presentation. My name is Peter Barton. I'm, as Julia said, a director here with Elliott Davis in our Charleston office. I provide a lot of the services that Julia mentioned, sort of on-demand or fractional CFO services to all companies at different stages in their life cycle, oftentimes working with startups and then established businesses that are looking to exit.
Yeah, and I'm Ryan Loveless with, as Julie mentioned as well, a director in our Greenville office. A little bit of a different role than Peter. I work in our management consulting practice, and my experience has actually been in kind of on the front end of the process of helping companies with growth strategy, operational planning, sort of transformation activities, which, as we talk today, I think will go hand in hand with how you actually get to the exit of where Peter maybe comes in a little later in the process. As you think through the holistic strategy that you're setting, we'll talk more broadly about that than simply what to do when the time comes to exit. So looking forward to the discussion. And as Peter mentioned, I hope that everyone has plenty of questions for us. We're certainly happy to answer and go beyond the materials that we present today.
All right, so we'll kick it off, and so I think everybody knows what's in front of them here. A Segway scooter, actually called a Segway Personal Transporter, to be precise. So just to provide some facts of Segway. It was developed, or the company was founded in 1999 to develop non-medical applications for self-balancing technology, and somehow they got a personal transporter out of it. Around $100 million was spent in the initial development of the Segway. I'm sure most people on this call remember the hype machine that was happening around this time when this, kind of eccentric entrepreneur was touting, the breakthrough that his invention will create. We have a quote here that he said, this will be to the car what the car was to the horse and buggy. There were other folks, with insight into what the technology that was being developed, and there were some predictions that this company would be the fastest to ever reach $1 billion in annual sales. I mean, just sort of crazy. Once again, very crazy growth estimates and unit sales very early in its infancy. What ended up happening in about the first 3 or 4 years, or rather 2 years since the product was launched, only 6,000 units were sold. In 5 years, only 25,000 units were sold. All the units then had to be recalled about 5 years after because of software glitches that caused the Segways to suddenly reverse. There was an exit. 2005, a Chinese company purchased Segway. We're not sure fully what the price wasn't fully disclosed. There was a capital raise of about $80 million from investors to finance the purchase. But now is the company that we know as Segway. It markets its products to in very niche markets: police departments, military bases, mall security, warehouses, corporate campuses, industrial sites. They are adding new products here and there, a lot with robotics, personal scooters, and that sort of thing. And the company does have some pretty good IP and other technology that is yet to expire. So who knows if they'll be able to get there and monetize that. But the reason why we're sharing Segway, in this manner, and to set up what we're going to walk through, is really as a cautionary tale, because we do acknowledge that the product was revolutionary for its time. That elements of the self-balancing were new and first to market in that regard. But a product alone does not create a company. And I think that's the takeaway with Segway. And then additionally, a product alone may not be able to be monetized or is something that's able to be exited from. So,
well, look, and I would kind of jump in there, Peter, and I would say, like, as we're going through this, and I'm sure as everybody on the line is kind of looking at this example, Segway is still around, and it is, arguably still had a reasonable amount of success. I think what the thing that we'd like to highlight here is there was so much hype around the company in the beginning. It is a revolutionary product, and as we think of where the company has gone and matured to over time, there's a misalignment there, and it comes down to what we're going to talk about today on the exit planning side, which is there's more than in the beginning of getting the product right. There's where am I going to go with the product, and how do I think through all of the decisions that are beyond the product that, I find that in working with many, entrepreneurs and startup companies there's I need to perfect this product before I put it into the market. And there's not time spent on actually defining what that market really is for the product. And so you get so caught up in the technical aspects that you forget on the business side. And I think this is a prime example that Peter's kind of highlighting here is, yes, it is a fantastic product, but it was at the expense of the price point is so high that I personally, don't see a need for buying several $1,000s to increase the speed at which I can kind of move about or walk, or replacement to a bicycle, for instance. And so, one of the things we wanted to help people think through is just kind of stepping away from the product itself and looking at, I have to have a strategy, and that's where it starts before I can think about exit planning. Is I've got to know where I'm going as a company.
Yeah, very, very well said. And we're assuming that that's why most people are here today, is to evaluate their business strategy and evaluate the landscape of potential exits. Once that company starts to perform and has some results. So I'll turn it over to Ryan to introduce the business playbook that you all can incorporate in your planning.
Thanks. So one of the things that Peter and I wanted to do as part of this, as I mentioned, is come up with some sort of, how do you actually get to the idea of an exit plan, or in this case, what we'll refer to as the monetization piece of a playbook. And we really came up with, there's 5 components as I think through the steps that any sort of business should go through. And it starts with defining a purpose. I think if you come back to it, you always have to have that North Star, or an understanding of, this is what the goal of the company will be, very clearly defined, of where I see myself as a company in 5 years, and how I'm going to interact with the market, broadly speaking, and what purpose I'm trying to achieve for a target consumer or customer. And then you can kind of step down the list of, if that plays out, the next step would be in the application phase of selecting your target customers and understanding where your product fits in. Of, this is what I want to do. Do people actually respond to that? And so if you think of the Segway example, of, I want to build a personal transportation device, there's probably a max willingness to pay that somebody is going to have on a personal transportation device of the alternative that exists in the market is a bicycle. And if I'm competing against that, I need to know where my price point is relative to it. So it's not just having the product, it's actually thinking through the application of your product and where it fits into the market. And then you get into a positioning of having a very clear go-to-market strategy of, if I'm a Segway and I'm competing against a bicycle, what are the things that I actually need to focus on, or think about the channels in which I'm going to be selling in order to maximize my success? Do I start geographically of it's probably best to focus on big cities because I see less use of that when somebody's taking a car. It's not a replacement to a car. It's a replacement to being able to go within a street. I mean, these are all kind of things that are obvious when you think about it in terms of Segway, but as you get to I'm sure the businesses that you are all involved in, it may not be so straightforward, but having that general sense of, where do I fit into the market, and how am I going to go to market, and where do I fit relative to my competitors, is critically important. And then you get to the implementation of actually proving the concept there of, what are the things that I need to be successful? Can I prove to an investor that I can do this successfully, that I have the scalability component there of, I can do this not just in one market, but this could be taken to other markets. And that ultimately leads to, the end of where we talk about, which is monetization or exit planning, of telling that full story, start to finish, and having a clear picture that you can provide to investors that is necessary in order to monetize at probably the highest or best outcome for you of we don't want you to monetize and have to go do the another company right behind it, because you've basically just gotten enough funding for that. It's really, I want to monetize to where I can go sit on a beach for the rest of my life, and not have to work again of this is an idea. And so hopefully we can kind of talk through what can get you to that point of really maximizing the value of a company and being able to translate success into value. And so if we start with the purpose, essentially think of this as defining the why behind your big idea. And there's 2 questions or that I kind of come back to on the purpose, which is, what is your product or service? Why is it exciting for someone? If there's no excitement that you can build and it's simply a replacement product, I think you're going to run into issues further down the line. There's got to be something there that is, innovative, revolutionary in some way, and it doesn't have to be to every person. It can be to, I'm carving out a specific target person that I think will be excited about this product. That's fine. We'll get to the is that enough later, but somebody needs to be excited by the product or service that you have. And if you can't find a specific person that would be enthusiastic about your product or service, then probably worth shutting it down at that point. And then what will it help to accomplish or improve? I think as you look through, where do you fit into the process or the market, being very clear on where you actually fit in. So if I step back to Segway, you go, okay, well, I'm going to improve the transportation of somebody, or the commute, somebody's morning commute, theoretically, in a big city. Well, there's a value that I can attach to that of what's that worth to someone. And I can start to think about it in business terms of how successful can I be, but I need to first kind of think through, like, what am I actually improving, and what is therefore the value of the improvement that I'm able to provide with my product or service. And that's kind of what leads you into the application side of things of, well, what is the value proposition and the market for that value proposition? And so as I mentioned earlier, you kind of get into, who is my target customer for the product or service? What is their willingness to pay? What is the market opportunity that results from that? And then the final question there, is there a market void, right? Is somebody not serving something today? Am I a unique player in the market? Do I have a carve out that I can make for myself? I think that's ultimately where a lot of companies could get potentially held up, is in being able to answer these questions effectively. And
Ryan,
I would say, yeah.
Ryan, why don't you relate it a little bit to Segway? Did Segway make or rather meet all four of these objectives?
Yeah, and so that's where, and again, I feel like we're kind of picking on it, and I'm sure others in the audience will have a different perspective. But I would argue that I think if you went through these questions for Segway, you would find that there wasn't really a market void or a gap there that you're filling. It's kind of a novelty of having a Segway versus an alternative. And so then that's when you get into the willingness to pay for me kind of falls apart. You see certainly plenty of Segways around in a tour guide setting, right? Of like, it's a novelty, but it's something that I'm not going to pay for as a replacement to the alternatives that exist in the marketplace. And that's, again, kind of my own personal look at it, but I think that's kind of borne out or played out in where you talk about the hype around the product, and as you get to the application of it, it's just kind of not there, and people don't see the value in purchasing something for as much money as it costs, basically. And that's where you get to, so if we think of the next step of positioning, right, of setting that go-to-market strategy. So once I've actually defined my target customer and established that I think that there is value for it, I think you can be really clear, and this is where I spend a lot of time working with companies, is I think there's three big questions that everyone needs to be able to address very early on in the process. And that is, how will I reach my customers? What's happening in the market around me? And what are my competitors doing? And there's a plethora of frameworks that exist to kind of help with this, right? You think of your typical SWOT analysis, certainly familiar. I'm sure most folks are familiar with the Michael Porter 5 Forces, the growth share matrix analysis that from Boston Consulting Group, and then if you think of an experience curve of understanding, where you fall on that. Those are the examples that are kind of on the slide here today of, you just think through all of these questions. you kind of take a step back, and if you can't answer these succinctly, then I think you've got a bit of an issue of, and as you start to play out of, okay, well, how will I reach my customers? And we go back to the example that you have of, well, am I going to sell or have a geographic focus? Am I going to sell through a specific retail channel? Am I going to sell online? All of those things have significant implications in how the consumer or customer is going to interact with your product and see your product. Are you selling as a partner with another product that you're kind of integrated with or attaching to? I think of, you think of a company, and I'll kind of pick on Salesforce, for instance, of a CRM technology, right? There's plenty of companies out there that sell, as an example of, as an attachment to Salesforce, and they market themselves appropriately. There's no standalone value for a technology that exists without the Salesforce technology, and that has a fundamental impact on how you go to market and think about selling to a specific business. Of, you actually want to think about it very differently than somebody that's selling a standalone technology platform like a Salesforce. And you could do that for any example of in a number of markets. Of the way that I go to market has a significant impact on my product and how I market my product, how I build my product, and how successful I will be in actually selling my product. And then as you go to the what's happening in the market, right, I think it's critically important to think about consumer trends constantly. You go to what will be happening in 3 years, in 5 years. As you think through the examples of, what will be an alternative that exists. If I think of, and this kind of goes into the competitive side of this, of if I think of the competitors or the players that are in the market today, how does my product stand up against what they're doing today, but what they can do in 3 years? And that's where you get back into the SWOT analysis, right? Of what is a threat to your business, not just today, but in 3 years. Of, is it easy for, if I'm attaching myself as a bolt-on product or integrating with another technology, can that technology platform not simply build the technology that I've built and kind of replace me? And that may be the case, that may not be the case. But I think understanding that and thinking through that of where you fit in will be important, and it's a good exercise to go through earlier in the process rather than later. And I'll also add that I think it should be completely iterative, right? Of, if you're not thinking through this and doing this on an annual basis, at some point you will not be innovative enough to keep up with the changes to the market and the trends that are taking place. And so then we can get into the kind of the next phase of the playbook of implementation, right? And what we really mean here is demonstrating the value that your product or service can provide. This gets very much to the proof of concept. And I think there's 4 key components here that are on the screen in front of you, right? Of demonstrating that functionality, of showing that you can sustain results, being able to highlight the successes of early phase efforts, and then actually showing that there's some sort of cash flow that can be had here. And I think if you can do all of these things, and I know that that's a lot or a lofty ask, I think that'll certainly set you up for success when we think of the monetization of the business. As I look at this, there's very different ways that you could go about showing something like this, right? If I kind of talk of, if you think of the Segway example, right? If you could theoretically show, if I can do this in New York, right? Then I don't actually have to show that I can do it again in Chicago, but I can simply do it in New York and then demonstrates the capability. And I may not have the scale or the resources to actually take it to the next step, but I can choose an appropriate pilot or target geography or customer base in which I can really be successful, and then I can get it, and then that'll allow me to show capabilities, proof of concept, and I can turn that into the monetization aspect and then take it further. So I think this is actually, there's a component to this of doing this in a way that will actually allow you to get the resources that you need to take this full scale. And I think you need to be conscious of, as you're going through this, what is the budget that you have, and how can I do this in a way to where I can demonstrate success with that budget. I think people kind of tend to go big right off the bat, and if that's necessary for the product to be successful, then okay, that's what you have to do. But I would argue that a lot of times, you think of something like a pilot or a target customer, and I do that really well. That's a much better approach than trying to be everything to everyone all at once. If I can get this and I can prove the concept, then I can take it from there and go forward.
That's great, Ryan. I love your thoughts around pilot programs and really showing some meaningful results with a defined target group rather than haphazardly, approaching the market. Well, it all may be an addressable market, just scratching the surface in each target groups or geographies or products, services offered can really dilute the intended results, which really speak to the monetization. And Ryan did a great job of walking through the elements that we find that need to be there, frameworks for the business strategy that underpin the ability to monetize. So we think that monetization can be summed up in with three elements, and really it's the data that supports the business. It's the measurement and the KPIs for success, and then it's being able to turn that story and the data into that future plan if your business is absorbed by a strategic or absorbed by a PE or bolted on to an existing roll-up strategy. Where can the business go? Where's the upside for all parties involved? And then within the measurement of the KPIs in the data, these are metrics to really measure growth and measure efficiency. And so, in growth, we think about metrics like revenue run rate, right? So it sort of demonstrates a ramp on a ramping revenue. Average revenue per user, then that can be compared against your customer acquisition costs and churn rate. So how long or lengthy, how sticky is a customer to you? And, those components can build a revenue growth model. And then on the efficiency standpoint, a lot of companies take time to get cash flow positive. So having an understanding of burn rates, how long will the cash that you have or the capital that you've raised sustain you to get to the next milestone, to get to show the meaningful results with a pilot group, if you will. The ability to understand your fixed versus variable cost, that goes hand in hand with your revenue growth and your demonstrated ability to scale, and then also your gross margin, which is measuring your kind of unit economics on each particular delivery of the product or the service. What does that cost you just to deliver that service? And so being able to package all of this up alongside your story of the purpose, the application, the positioning, the implementation, and then project forward allows the company and allows you as the owner to monetize and move forward. We have this is sort of a natural place to pause and take some questions. We have some cases that we're going to walk through that more succinctly view the elements of the playbook and monetization just as examples. But are there any questions that have come in, Julia?
Yeah, hey there. So this is Julia. If y'all want to go ahead and start typing questions into the question panel on your webinar controls, I will read them out loud and the guys can take a minute to answer them. I just personally want to say thank you for that, the very first slide with the segue. What a great sort of analogy. We all know the segue story, and that was a great way to start. So I just want to say that out loud. Thank you for that. Yeah.
And I'll jump back in and say, we're defining an exit just so we can level set everyone's expectation. And monetization is really the eventual exit to a PE group, to a strategic, even an IPO, versus the incremental fundraising rounds where the capital that's being raised goes back into the business for growth capital. This is really a recapitalization and cash out for the founding group. Just so everyone is on the same page, it's not monetization for us is not necessarily path to profitability. It's really that exit.
Hey, Peter, maybe while we're and hopefully there's a couple of questions coming in, but Julia, while we're waiting, one of the things, Peter, I think it'd be helpful even for me as you're talking through the monetization side of things, there were a significant amount of KPIs that you walked through and questions that are going to be coming at you from an investor. I know you've worked with a number of people that have gone through this process before. My question is, how many people do you find, or actually, do you find that people don't think about this until the end, until they're ready to actually monetize or cash out, so to speak? And if they have waited that long, because I'm assuming some do, how tough is it to go back and really put together a good story that makes sense for investors?
Yeah, that's a great question. I'd say that it depends on the experience of the founder and the entrepreneur. Generally, second time or third time entrepreneurs or founders, who have gone through some type of exit, understand the importance of developing the KPIs and the data earlier in the process, because it does allow you to measure and track and show results against plan. So that population of folks is more apt to use data to help tell the story. There are some industries that are better. Any type of subscription model, companies are generally diving in very early into developing metrics and data around revenue per customer, annualized revenue per customer, and that type of thing. Probably less so when you get to some of the cash burn and even the fixed to variable cost, just to be able to understand the scaling and the potential growth. But I'd say more and more folks are focusing on it.
Okay, I'm just going to jump in here. There have not been any questions that have come in so far, but don't worry, I'm sure they will come in any minute now, and I will interrupt as they do. But I will just say the floor is yours again to continue on with your monetization slide.
Thank you.
Thanks. So as Peter mentioned, I think the next thing for us is we wanted to take this and kind of walk through with a couple of examples to help give it a little bit of meaning. And so the first that I want to kind of talk through on the screen is, and you'll kind of see the customer or the label there of Ship, of the company. In this case, I'm not sure how many people would be familiar with it, but Ship was founded in 2013, and the intent was provide through a mobile application of helping people to essentially package and ship products. So rather than having to go to the UPS store to drop something off, Ship will both package, come pick it up for you, and get the scheduling done. And the model was charge a $5 flat fee per package. And as you think about this, I mean, they ended up early on in the process raised a total of $62 million in venture capital funding. And we're operating in several cities of New York, Miami, LA, Chicago, and Philly. And we wanted to kind of walk through this example because that company has since shut down in 2018. So you think 2013 to 2018 as a 5-year run. And as you kind of just step through the playbook, so to speak, and the way that we've thought about this, I think it really starts to fall apart as you really pressure test in some of the different areas, the model that they were selling under, right? So you have the purpose of removing the hassle and stress from mailing packages, right? I can get behind that idea of personally, like it's a real pain. And yes, you may be willing to pay for it in some regard as you start to think through the application, right? If it's a frustrating process, it's only $5 that they're charging. If I'm doing a one-off shipment for sure of like something that's big, I don't want to have to go find the right package to put it in and deal with a lot of that. If I'm just kind of starting up, hey, I can simply fill in an application and use a mobile app and just fill out the criteria, and you'll come pick it up from me and deal with everything else. Where I think you start to run into issues is if you think through the target customer there of, if I'm sitting in as a consumer for this particular product, right? Like that happens to me very infrequently where I'm actually mailing a package and I'm going through something like this. I kind of go to, if I'm pressure testing this idea, right, of the people that actually have this happen a lot, they've also actually probably thought through how they're going to package and ship things. So I really question the consistency of the demand when you think about an individual in this case of, yes, I may be a target customer, but my demand profile is that I only use you in a very one-off scenario. And that's probably the case for a lot of the customers. And what you actually saw is a shift in their marketing strategy of early on, it was probably more of a broad-based targeting to ultimately near the end in 2017, 2018 timeframe, focusing on small businesses of can we capture and kind of better support small businesses who have that more consistent demand rather than me simply running around with, individual consumers all over the place. And that actually gets you into the positioning of, right, of it's a clear value proposition. But if you start to think through the go-to-market strategy, well, how defensible is it? Of theoretically, the Postal Service, FedEx, UPS could change their model and just add this on the front end of their process. So essentially, they're ultimately using all of these big names and just taking a little bit of a chain and trying to take some sort of share of wallet in this case and add a bit of additional value proposition. You look at the long-term feasibility and you kind of go, is it really there when you think about where you're trying to fit in? And where that probably shows itself is in the implementation of this is a combination of the two above, right? Of I don't actually own enough to where I can make decisions myself and control my costs effectively because I have this inconsistent demand. And so I can use technologies to help with the schedulers, but ultimately I have to have somebody staffed that day. And if they're only running around and doing a $5 shipment and I don't have enough $5 shipments in a reasonably close proximity for that particular time, I'm losing money on that particular day. And so you kind of go with where you're trying to fit in with a concept like this, as you put it into reality and start to think through it, I'm not actually able to get who my target customer should be because the people that see the value in this don't actually use the product on a consistent basis. It's more of the business person that I want to capture. And those business people, UPS, FedEx, they're actually offering solutions for you that are probably more holistic in nature than what you typically see as an individual consumer interacting with. And that's where ultimately you think of, well, the goal of every company is to monetize in some form or fashion, right? So I guess in theory, thinking that you would sell to a UPS or FedEx is just kind of be absorbed into the process of we can do this better of tracking on the front end and interacting with the consumer and making it an easier process. But again, I kind of go back to, well, if you think of that being your end goal, why am I going to acquire somebody for it if there's no user base that I'm going to be paying for? Because as a UPS or a FedEx, I already have that person or that business. They're already going through me. I'm not gaining anything from it. And so you really start to see, if you step through each of these questions logically, the model kind of breaks down of you can pick and prod and poke holes in the model. And that's ultimately what you saw with the shutting down in 2018. So the 5-year run, despite, that early, wow, there's a lot of excitement around this and we can get $60+ million in funding, because it's at face value, it does come across as like this is something that it's bothersome for me as an individual consumer, and I would feel the pain there and think that there's a market for it. But as you start to tick through the list, just really doesn't stack up, is what I would argue.
So we've shared now a couple failures, or rather not necessarily successes. So I'm sure you want to maybe take a look at some successes, but before we get there, just once again, we're sort of defining monetization as that exit, and there are different options. There's a private equity bolt-on or roll-up. Maybe you're not the platform. A platform's already been created, but you can kind of come along for the ride. Oftentimes a lot of the proceeds from the sale are going to be rolled up or rolled in. It's just going to be your stock for their stock, and you'll continue to be along for the ride, and may take 2 or 3 eventual sales to fully monetize. Kind of moving up in desirability is a sale to a strategic, either to be there, a new product or service for them, or to come alongside an existing service that they have. Some of the entrepreneurs that I have worked with who have sold to strategics, the one thing to keep in mind is, now you're going from the guy and the boss to an employee. And, that dynamic is a little bit of a culture shock to them. Generally they're tied up for, 2 or 3 years, from exiting, from selling their shares. So just something to think about in the process. And then, I think ultimately most desirable is an IPO. However, the probability of that occurring is very, very low, but it's always out there. It's, I think, what most people or founders are excited about. When they create a business that has that ability to scale and get worldwide market penetration. So as we now look to some successful exits, want to take a look at this company, Vine. It was created in June of 2012. I'm sure a number of people on this call were a user of the service, and it was a short-form video hosting service where users shared 6-second long looping video clips. It was a free app, and very, very quickly, Vine had about 200 million active users. And in October 2012, Twitter reportedly purchased Vine for $30 million. So, great. Talking about all the elements of getting to monetization, 6 months or less than 6 months. Ultimately, the Vine app was discontinued by Twitter in October of 2016. But let's take a look and step through the playbook, and we're calling this 4 out of 5 ain't bad. I think most folks here would take the run that Vine had. So the purpose of video hosting service at the time, trying to think back to 2012, cell phone coverage and service still wasn't as good. Video, wasn't as accepted as a form of communicating with family and friends and others. It was mostly still pictures. So it was new. Video, just proliferation of video was at its infancy as an application. However, how are you going to monetize the active users? What's your path to profitability? And it's just sort of interesting when I looked at Vine and maybe thinking, well, what's Vine's closest competitor? It's Snapchat. Snapchat has a $20 billion market cap, but they're losing about $1 billion a year. So I think similar companies still trying to figure out how to get that path to profitability in this business model. It's we have short attention spans, and for a 6-second video, it's tough to find advertisers and that sort of thing. Positioning, Vine was great, really ramped up 200 million active users very quick. But what type of barrier did they have? On the implementation side, the technology worked. It was widely adopted. It was accepted. They had results. They could measure user engagement but the problem is, that just those barriers didn't exist. Cash flow, a path to cash flow was non-existent. They had this first mover advantage. So, maybe at this time, if you find yourself in this position as an owner, maybe the time is to evaluate a quick exit. That you have demonstrated your ability. However, there are other more dominant players in the landscape of providers. Maybe the time is right for an exit. And so I give the monetization here 2 checks. Twitter reportedly purchased Vine for $30 million. The value for the company was in the activity of the users in the growing user base, and how Twitter could incorporate the user base in what they were doing. And so, I think that as we think through and step through the playbook, most of the elements are there and are lining up, which then allowed Vine to successfully monetize.
So we wanted to do one last one here and give a kind of round it out with a truly something that can really clarify exactly how this could be done. And I flip to the next slide here of I'm sure everyone is familiar with this screen of Netflix and very not surprising to anybody to see this and when you get to a success story. But I actually want to tick through this one because it's not just picking, you may say, oh, well, you just picked a successful company and you can kind of apply this. Well, I think you can actually step specifically through and very clearly see where the successes come from. And so you start at the top of certainly the innovation, and we go back to the purpose of having something that is exciting. At the time, we think of Netflix today as a streaming model, right? But at the time, it was actually just direct DVD, shipped to your house, which is in itself transformative for the time. If you think of the Blockbuster model, was always the traditional model of a way that you would interact with renting DVDs. And so you go, Netflix kind of demonstrates of an exciting idea where anybody could say it's a fundamental shift in the way that you do business. There is a clear, as you look at like application and your willingness to pay for something like that, if I can get to a subscription model because I'm already doing this today and you're lowering the cost for me on something. So you tick through the positioning of, right, if I need to be at a price point that both people can afford. But if you think of, if I'm doing this in mass quantity and I'm not actually having to have the cost base that many of my competitors have, in this case of a Blockbuster, I can do that at a price point that makes sense for both myself as a company and also individuals. And then when you think of just like the implementation side of things, right, of you've got to make it work, but it's easy on the logistics when you're talking about the number of subscribers that you have, and you can think through, they're shipping DVDs at the time in 2005, but now it's a streaming model where you're able to host, a lot more people, right, of the 150 million subscribers that are out there today. And you go to the monetization, right, of $15 a share, 2002. Obviously, a significant amount more than that in terms of company value today. But you kind of look at this one, and it's pretty easy to see where the successes have come from as you go down through and kind of tick it off of innovative, of really filling a void that is intuitive after the fact. I don't want to say that, if you just kind of look around, you could easily see that it wasn't, that the opportunity was there. But as you reflect on it, yes, the opportunity was certainly there. Harder to see at the time. So I don't want to suggest that it's easy and an obvious answer for somebody to have created this model. More so that it is just actually filling it does actually kind of fit the bill of being applicable and being able to answer all of those questions effectively that we talked about. And same as you think through the positioning and the implementation, right? And so with that, Peter, unless you had anything else, I think we would kind of step back to, hopefully at this point, maybe with the conclusion there's now questions that we're certainly willing to take from Julia. If you've got anybody else, some questions that have come through here as we've continued to talk, we'd be more than happy to answer. Julia?
I'm sorry. Hey, this is Julia. I'm speaking on mute. Sorry there. So, yeah.
Sorry, I was just, at this point, we didn't have any further content, and so I was just pausing and saying we're happy to answer questions for the remainder.
Yes.
If
exactly. So we will go ahead and open up the line again for questions. If anybody has any follow-up questions, please go ahead and type them into your webinar controls. While people are typing away, I just want to say thank you to you both for providing this content and making yourselves available. And, really how we kind of planned this was a 4-part series, right? And we talked about cash flow. We talked about the basics of accounting. And now we're following up with, exit and succession planning, and Janelle Fox with Elliott Davis. Another team member of mine and myself, we planned this, and it really has been a really successful, 4-part series. And I'd like to, just ask other people that are in the audience, if you do have any suggestions for future webinars, please do not hesitate to let us know. We are only here to serve you, so if you want to hear something, please let us know. Don't hesitate to throw those ideas out there, because that's how we plan these in the future. So I'm looking at the questions now. We don't have any questions coming in, but I will email everyone who was on the session and provide the contact information for Ryan Loveless and Peter Barton with Elliott Davis. I just want to say thank you so much, both of you again, for providing your time for today's webinar. And this webinar will be available on our website at sdra.org/resources. If anyone would like to see that information, you can find it there as well. So Ryan and Peter, thank you.
Thank you so much. Hope everyone has a great week.
All right. Happy holidays to everyone. Bye-bye.